Hi guys, welcome back to my channel. Kelvin here. A few weeks back, after I revealed that I was earning a few $1,000s every month from options, a lot of you guys wanted to know how I did it. And guess what? That's what I'm going to do today. In this video, we will go deeper. I will reveal everything you need to know about my option strategy. Stuff like what are the stocks that I'm doing this on, how to achieve this kind of godlike returns, what's my portfolio size, what are the money profits, and why I'm using margin to sell options. Yes, you heard that right. I'm using the scary thing called margins. I'll talk about all of it in this video. But before that, I would greatly appreciate it if you can help to tap the like button because it will help out with the algorithm. In return, I will show you a very cute puppy. Alright, with that being said, let's start right now. A quick disclaimer, I've only been doing this for a few months and I'm by no means an options guru unlike Chicken Genius. As you can see from my name, I'm just a random YouTuber who's still learning how to invest. So you should definitely, absolutely, 100% not follow my options strategy blindly, yeah? Okay, the two strategies that I'm using are just covered call and cash cow put. That's all. If you are blur and don't know what's these two strategies, I've talked about these strategies in the past videos. Talk until my saliva also dry. But I will quickly explain these two strategies. In cash cow put, I'm making a bet that the stock won't drop below a certain price. If it drops below, then I will need to buy 100 of the stock at that price. As for covered call, I'm making a bet that the stock won't go above a certain price. If it goes above, then I will need to sell 100 of the stock at that price. So simple. In both of these strategies, I'm receiving cold hard cash immediately when I sell the options, which is nice. Alright, now we know the basics. Hopefully, let's jump right in. I actually have two different portfolios for my option strategy. Let's first start with the first portfolio, which uses the wheel strategy. Just in case you don't know what's the wheel strategy, basically it's like this. I got the cash cow put, I got the covered call, I got the wheel strategy. So in the wheel strategy, I first start with cash cow put, which is betting that the stock won't drop below a certain price. I will keep repeating cash cow put and collect cash every time until one day the stock drops below my strike price and the broker be like, now buy! Immediately after that, I start selling covered call, which is betting that the stock won't go above a certain price. Again, I will keep repeating the covered call and collect cash every time until one day the stock goes above my strike price, then the broker be like, now sell! Then I will do cash cow put all over again. So that's basically the wheel strategy because it just alternates between cash cow put and covered call while I collect cash every time. Oh yeah, a few of you guys asked me if it goes in the money, when will you be assigned stocks or when the stocks will be called away. It mostly depends when the options buyer decides to exercise the options. So if he decides to exercise his put right now, I have to buy the stock like right now. But in most cases, in the money options won't be exercised early. Instead, it only gets exercised after the market closes on expiry day. That's because brokers will automatically exercise the options if it's in the money, unless the buyer specifically asks them not to. Anyway, let me show you my trades now. I started the wheel strategy since October 2020, and most of the time I'm doing weekly options. My first stock was Bank of America. Bank of America was a logical choice because it is stable and it is cheap enough for me to sell options on. If you look at this trade, I lost $50. It's because in November, I sold a call at $24.50 strike price. And that week, Bank of America suddenly shot to $27 and I was forced to sell Bank of America at $24.50. That's the downside of selling options. The stock can suddenly move up or move down and you'll be forced to buy or sell the stock. Looking back, I could have avoided this loss by just rolling the option. Just in case you don't know what's rolling, basically I buy back the option at the loss, then sell a new option at a further expiry date and at a further strike price. Let me show you an example. Let's say I sold a Tesla call option at $680. Right now, the premium is $15.30 and it will expire in 5 days. But maybe I don't want to let my Tesla get called away at $680. So I choose to buy back by paying $1,530. Then to cover this loss, I will choose a much further expiry date, let's say 26 days later, and sell at maybe $720 strike price. I will receive $1,525. By doing so, I will achieve two things. First, I don't have to sell my stock at a loss immediately. Second, I extend the time I have on the option, so it can move in my favor. If you look back at the Bank of America chart, right after it shot up to $27 in November, it stabilized at around $29 for 1 month. So if I just roll my option, I would have avoided the loss and would be able to sell Bank of America at a higher price. Alright, that was Bank of America. Right after that, I was mainly selling options on NIO for a few reasons. First, NIO's implied volatility is much higher than Bank of America, so I can earn slightly more on NIO. Second, NIO is cheap enough for me to sell options on. But most importantly, I like the stock. Even if I were to get assigned, I wouldn't mind holding NIO over the long term. So as you can see, I was able to sell options on NIO for a few months without any issue. This negative $1,300 loss was because I sold a call below my buying price. And again, I could have avoided the loss by rolling my options. Right after NIO, I got a little overconfident and started selling options on Riot. Riot is a Bitcoin mining company, and its stock price somehow moves together with Bitcoin. I broke the most important rule of selling options, which is to only do it on stocks which I like. I didn't like Riot, and guess what? The options god wanted to teach me a lesson. Immediately after selling 2 options on Riot, I got into trouble because the stock suddenly went down. This loss that you see here is just me rolling my option. I bought it back at the loss, then sell a new option to cover the loss. Bought it back again at the loss, then sell again to cover the loss, until eventually I got assigned 200 Riots at $45 strike price. And I've been stuck with Riot stock until now. Luckily, I was able to keep selling call options on it to lower my average price. Right now, the total premium that I've collected on Riot is $2,000, which means my average price of Riot right now is $35, which is very near to the current stock price. So it will be fine if my Riot gets caught away, because I won't be losing a lot of money. Next, you'll see AMC also. Yes, AMC. I'm sure you'll be like, what? But hear me out, this was a calculated move. I sold the option when AMC was going to the moon and the implied volatility is over 200%. The strike price that I chose were like 50% away, which means AMC will have to drop by over 50% in 7 days for me to get assigned, which I felt was unlikely. But yeah, this was another brave but stupid move. I stopped selling puts on AMC once the implied volatility dropped and the stock went back down. So those were my trades on the wheat strategy. As you can see, other than the loss in February, my monthly profits is between $100 to $1,400. Over 10 months, my total profits for this strategy is around $5,000. The total capital used is about $18,500, so the return is 27% over 10 months, which is not bad for a start, but it definitely could have been much higher. Okay, so that's the real strategy, which is selling options using my cash. In my next portfolio, I'm selling options using my portfolio. Let me explain. To do this, I buy and hold at least 100 of these stocks that I like. Then I start selling call options on these stocks. Then you'll be like, but what if the stock suddenly shoot up? Then you'll be forced to sell away your stocks lor? You are right, so to avoid this, I sell call options at either 20% price distance or 0.1 delta, which means my stocks will have a very low chance of getting caught away. So far, my stocks haven't been caught away yet. But if one day it reaches the strike price, I have 2 options. First, I will let my stocks get caught away, then immediately sell a put option to get the stock back and to earn extra money. Or second, I could roll my call options to avoid letting my stocks get caught away. So that's the first part, selling call options on my long-term stocks. And because I have a portfolio, that means I have margin too. So I'm also selling puts on margin. Then again, you'll be like, wow, margin very dangerous ah. You play with fire ah. Yes, that's true, but think of it like driving a car. It's also dangerous, right? There's a 0.82% chance that you will get into an accident in Singapore, but people still drive. That's because if you have safety precautions, it will lower your chances of death. Like you drive carefully, wear seat belts, have working airbags, check your brakes regularly, that kind of stuff. Same for me, I also have multiple safety precautions in case my puts goes in the money. First, of course, I make sure I have cash in the bank in case I ever need to buy the stock. So even though my put options are on margin, it's actually not a fully naked put option. Second, I sell at a very far price distance. Instead of the normal 0.3 delta, I sell at around 25 to 30% price distance. That means the stock will have to drop by over 25 to 30% for me to be forced to buy the stock. Third, I don't use up all my margin like a baka. This is to avoid getting margin call in case the stock suddenly crashes. Fourth, even if the stock crashes, I can still roll the options to avoid getting assigned immediately. So yeah, I have all these safety precautions, which makes selling options on margins a little safer. Alright, now you know the idea of this strategy. Let's check out the trades. I started this strategy in October, but only started getting serious in December. As mentioned, the stocks for this strategy are just the stocks in my portfolio. Nothing special. I have Tesla, Square, ArcG, and ArcK. When I first started, I was still a noob. So when I see the stocks were going to be in the money, I immediately panic buy the close. That's why you see these huge losses here. Instead, I could have just rolled the options and avoided this kind of stupid mistakes. But after doing it for a few months, I adjusted my strategy and have been collecting money every week without any issue. As for the profits, at the start, I didn't know how to do it, so the returns were quite low. But after March, I got the hang of it and have been making around $2,000 to even $4,000 every month. After doing it for almost 10 months, the total profit for this strategy is around $20,500, which again is not bad, but could have been much better. So the 10-month return on this portfolio is around 8.2% for this strategy. By the way, I feel that this strategy will not always give such good returns. I was super lucky that Tesla and Square were going sideways for a very long time, and their implied volatility is quite high at around 50% now. I don't think that this will last forever though. Let's see. I've been doing weekly options since the start, but if I were to do monthly options, it will be much better for a few reasons. First, I will have higher profits. For example, if I were to sell Tesla option at $800 strike price, 5 days to expiry, I will get about $12. But if I were to sell 4 weeks to expiry at the same strike price, it's at $264, more than 4 times of $12. Second, it's much easier to roll monthly options in case the stock goes against me when compared to weekly options, so the risk is lower. Third, I don't have to keep going in every week to sell options because frankly, it's quite tiring. Not the earning money part. The earning money part is good, but it's tiring to log in, close the current option, choose a new option to sell, record it for every single stock that I own week after week. So yeah, I'll try doing monthly options from now on. Okay, if I combine both portfolios, you'll see that in the past few months, I've been earning around $3,000 to $4,500 from both option strategies. And the total profit that I earn is around $22,000 over 10 months. So far, I haven't touched the profits yet, but my plan is to reinvest it by using the cash to sell more options. Even though the profits are not bad, I'm very certain that a simple buy and hold strategy will outperform selling options. The main purpose of selling options is to earn extra income, not to beat the market, yeah? Think of it like collecting dividends on growth stocks. That's all. Anyway, if you're looking for a copy of this spreadsheet which I use to track my option strategy, I have a link down below where you can duplicate to use for yourself. You should be able to understand most of the columns. Credit is just how much you receive when you sell the options. Debit is how much you pay when you buy back the options. Okay, yeah, so that was how I earn money on options. If you have any questions or suggestions on how to improve my strategy, do let me know down below. I'll be super glad to hear it. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.